Welcome to Pinvest TV, India's first real estate channel. Let's dive into latest property news from Indian market. The Securities and Exchange Board of India has proposed new regulatory measures aimed at enhancing the flexibility and risk management capabilities of real estate investment trusts, small and medium REITs, and infrastructure investment trusts. One of the key proposals includes permitting these entities to use interest rate derivatives, such as swaps, for hedging against fluctuations in interest rates, thereby stabilizing cash flows and reducing risk, especially for long-term infrastructure projects. In addition, Sebi has suggested allowing locked-in units of REITs and InvITs to be transferred among sponsors and their groups, mirroring rules for listed company promoters. This change would enable sponsors to manage their stakes without compromising their required skin in the game. Sebi has also proposed expanding financial flexibility by including fixed deposits as cash equivalents when calculating leverage for REITs and InvITs, providing clarity on credit rating requirements for their borrowings, and setting timelines to fill board vacancies. Other proposals include allowing REITs to invest in liquid mutual funds, and defining common infrastructure to broaden REIT regulations. Facilities like power plants, heating, cooling systems, water treatment, and waste management plants serving REIT assets could qualify as common infrastructure even if located outside a single project. Power plants would be permitted to sell excess power to state utilities or grids, with credits or payments benefiting REIT assets. For enhanced transparency, Sebi suggests updating governance norms to ensure that InvITs report quarterly performance directly, similar to the requirements for REITs. This aligns with REIT regulations, focusing on the performance of the trust itself rather than just its investment manager. Sebi also proposed that nomination and remuneration committees of REIT and InvIT managers have a mix of independent and non-executive directors, similar to listed companies under LODR regulations. To improve investor protection, Sebi has proposed revisiting borrowing conditions for InvITs that exceed the 49% limit, evaluating REIT investments in unlisted equity shares, and clarifying trustee roles for REITs, InvITs, and SM REITs. In a separate consultation, Sebi proposed a framework for restricted return InvITs, designed to provide predictable returns for infrastructure investors, with both downside protection and capped gains. These InvITs would set a structured range for returns, limiting maximum and minimum thresholds to offer stability. Targeted at sophisticated investors, restricted return InvIT units would have high minimum investment requirements, with each unit priced at a minimum of 500 crore rupees and total InvIT assets amounting to at least 50,000 crore rupees. Investors would need to sign a waiver, acknowledging the structured return format and the terms of transferring excess returns to sponsors. Sebi has invited public feedback on these consultation papers, with comments due by November 13. We value your input. Your feedback shapes our content. Thanks for watching Pinvest TV.